everyone, this is Bergman, founder and CEO of IRA Financial. Welcome to another episode of AdBits, where I will be sharing bits of knowledge about self-directed retirement. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of AdBits. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's episode, the Backdoor Roth IRA versus the Mega Backdoor 401k. So I wanted to do a podcast on this topic because assuming the budget reconciliation bill passes in the next few weeks, which it looks like it will, considering the infrastructure bill just passed, this could be the last 7 or so weeks we all can do backdoor Roth IRAs and Mega Backdoor Roth 401k. So I thought it would be super important to spend just a few minutes educating all of you about what they are, the differences, and who can take advantage of them. So let's start with the Backdoor Roth IRA, which prior to 2010, if you had income above a certain threshold, you were not able to do a Roth IRA. 2008/9 financial crisis occurs, and Congress is looking for ways to generate more revenues. So they say, okay, let's encourage people to do Roth conversions, because when you convert a pre-tax retirement account to Roth, you pay tax on the amount of that conversion, and that is additional revenue for Treasury. So they said that would be a great idea. And let's also incentivize taxpayers to do it, and we'll let them pay the tax over 2 years. And that actually created a pretty large windfall for Treasury, and it was a very successful program. And what they ended up doing is they never closed that door. So the back door, which essentially allows you to make an after-tax IRA contribution, irrespective of income, since it's not tax deductible, and then convert it to Roth. And since the 2009 elimination of income threshold for conversions, anyone, whether you're Jeff Bezos or Adam Bergman, were able to do Roth conversions no matter your income threshold. So it opened up over the last 10 years for many, many Americans like myself to add $6,000 or $7,000 if they're over 50 into a Roth. It didn't really cost the IRS any money because it's an after-tax conversion to Roth, right? So it's not creating tax deductions. It's not taking money out of Treasury. It's just after-tax to Roth. And again, the limit is just $6,000 or $7,000 for backdoor Roth IRAs in 2021. So the point is, it's not a technique that's used for super rich people, right? It's used by you folks like me and you, people that want to put away a little bit more into their retirement account, whether it's a few $1,000 into a backdoor Roth, or a $6,000 or $7,000 contribution if you're over 50. It doesn't move the needle, but it's just another way of socking away a little bit more money into a Roth, having that money as part of your retirement account, and having that money work for you based off the principles of compounded returns. So unfortunately, under the proposed tax bill, which is expected to pass mid-November, the bill seeks to eliminate the backdoor Roth solution, essentially put back a rule that you cannot, irrespective of income value, no longer convert after tax to Roth. So if you're no longer able to convert after tax to Roth, the Roth conversion backdoor is dead, because there's no point of having an after-tax IRA because you're in no man's land. You don't get that tax deduction like a pre-tax IRA, and all the earnings associated with that after-tax account, all the interest, dividends, royalties, rental income, gains, will be subject to tax like a traditional IRA. So you get no tax deduction and you don't have the benefits of the Roth. So you're really in no man's land. There's really no reason to do an after-tax other than this backdoor Roth IRA, which the tax bill seeks to eliminate. So bottom line, this could be the last year, 2021, if you're listening, that you can sock away up to $6,000 or $7,000 if you're over 50 into a Roth IRA, irrespective of income limits. Based off the current rules, if you make more than $208,000, you can married file jointly, you cannot have a Roth IRA. So this could be your last chance to do a backdoor Roth IRA and add a little bit more money to your retirement account. Kind of disappointed, honestly, by the Ways and Means Committee or the Senate Finance Committee, whoever actually reinserted this provision into a bill. It was removed at one point and then reinserted because it's just hurting people like you and me, middle-class people that are just trying to get by, trying to put away a little bit more money in their retirement account. It's not going to take money out of the Treasury, right? It's actually going to hurt Treasury because what will end up happening is instead of putting that $6,000 or $7,000 into a backdoor Roth, people are just going to add more to their 401k or do a pre-tax IRA. So it's actually going to hurt Treasury because pre-tax contributions are tax deductible, meaning it reduces taxable income, whereas after-tax to Roth doesn't impact taxable revenue. So it's actually going to hurt them. It's not going to solve any problems. It's just going to potentially impact low to middle income earners. The super rich people don't care about $6,000, right? If you're making $500,000, $600,000, $700,000 a year, adding $6,000 to your Roth, it doesn't move the needle. But if you're making $250,000, $300,000, or even $100,000, that extra $6,000 can help. So again, you can still do a Roth if you make less than the 208. It's just for the families that make more than the 208, they're eliminating this backdoor, trying to limit people's ability, at least they believe rich people's ability to do Roths, even though they can convert pre-tax to Roth, right? They want to stop this backdoor. So unfortunately, this looks like it could be the last year to do it. Now moving to the Mega Backdoor 401k, which really focuses on 401k plans, clearly. And it's the same principles of a backdoor Roth. You make after-tax contributions to Roth. The only difference in a Mega Backdoor, depending on your plan, you can put away up to $58,000 dollar for dollar, or $64,500 in 2021 dollar for dollar. Same principles as the backdoor IRA, but it's a way higher limit, right? Instead of $6,000 or $7,000 in a Roth IRA, you can do $58,000 or $64,500 in a Mega Backdoor. Couple things. You need a 401k. Most plans, if you work for Apple or JP Morgan, Tesla, most cases, even if they have the after-tax option, the plan ultimately is not going to allow you to do the Mega Backdoor. Why? Because it will generally fail what's called an ERISA/ACP, which is a contribution percentage test that's done separately for after-tax contributions. So unless enough rank and file employees are doing after-tax to Roth, even if the plan offers it, it's going to fail the ACP test and thus not be allowed under the plan. According to a recent Wall Street Journal article, they assume close to 20% of all 401k plans have this option in it, which could be possible, but I would say less than 5% of these plans, maybe even less, actually will permit and allow for these contributions to be respected based off the ACP test. So I actually spoke to a client who works at a big law firm in New York, and she was saying that her law firm does allow for ACP and Mega Backdoor Roth 401k. She wasn't sure if it's passed the ACP test, but she was like, Adam, I did it last year. So I know they allowed it, which I was surprised about because I worked at big law firms, and I can tell you most of the associates have no idea about the Mega Backdoor. They're just doing the employee and pre-tax or Roth. So when she told me that, I was quite surprised. I'm happy she was able to do it. Maybe whoever was doing the plan administration didn't do the test. Maybe they didn't know that the contribution was being done. I don't know. But in any event, it generally only works in solo plans. Why? Solo 401ks are not subject to ERISA. Thus, they're not subject to the ACP test. And therefore, if you do a Mega Backdoor Roth 401k and it's just you or another partner or spouse, you can do it even if your partner or spouse doesn't do it because there's no ERISA test, no ACP test. So that's why generally the Mega Backdoor 401k is used in the solo 401k context, even though it may be allowed or permitted in regular employee 401ks at big businesses or and the like. It's generally used in solo Ks because the fact is solo Ks are not subject to ERISA. So the difference is they both have the same principles. The main difference obviously is the backdoor Roth is limited to $6,000 or $7,000. The Mega Backdoor is 58 or 64.5. In the Mega Backdoor, there's no income thresholds. So if you make $1 billion or 70,000, you both can do the Mega Backdoor. In both cases, it's after tax to Roth. And in fact, in the Mega Backdoor in the 401k, you can leave it in the plan or actually roll it into a Roth IRA, which some taxpayers preferred. But based off the same principles, Treasury's not losing any money. It's after tax to Roth. And again, in this case, in the Mega, they're actually going to lose potential far more revenue than an IRA. Why? If you have a solo K and now it's 2022 and you're no longer able to do a Mega Backdoor, you may do pre-tax, right? Maybe you do 19.5 or 26,000 if you're over 50 in Roth, but your employer contributions, now that you're not doing the after tax, you're going to have the money to do the employer contributions. They have to be in pre-tax, which gives you a tax deduction and also reduces your taxable income. So again, I'm not sure their policy here. Clearly, the Senate Finance Committee or the Ways and Means, they're trying to stop Roth IRAs. I think they're short-sighted because the Mega Roth IRAs, the $25 million Roth IRAs, trust me, they're not because people are putting away $50,000 a year in a Roth. They're because people are hitting home runs in their investments, whether they're doing Tesla stock or Bitcoin or hitting home runs in SPACs, whatever it is, it's generally not the contribution that's creating this monster Roth, it's the investment. So to focus on the contribution and essentially dissuade people, or not dissuade, essentially stop, regular people like you and me again, middle class, middle income people that just want to put away a little bit more into their retirement account, stopping us from making that contribution. I don't see the public policy. It's not creating any tax revenue. It's going to hurt it actually, because I may do more in pre-tax, right, than I would otherwise because of the Mega Backdoor is not available. Assuming you're a sole practitioner, lawyer, or a doctor, consultant, accountant. If you can't do the Mega Backdoor, you're going to say, you know what, I'll take some of the tax deduction. I'll do the employer contribution in pre-tax and the employee in Roth, but I'm going to use some of that pre-tax, which will reduce my taxable income and create deductions. It means less tax Treasury is going to receive. And it's targeting small businesses because the Mega Backdoor is really only employed by the solo K. And who has solo Ks? It's small businesses, right? With no full-time employees over 1,000 hours other than themselves or a spouse or co-owner. So it's not Teslas, it's not Apples, it's not Intel. It's small businesses, whether it's a sole practitioner, a consulting firm, architecture firm, accounting firm. So it's really hurting, everyday Americans, people that are just trying to save, do everything they're told to do in order to, have retirement assets for their family, so they're not wholly relying on Social Security, doing everything we were told to do, and now they're going to stop it, which is too bad. It's not going to stop Peter Thiel's or Jeff Bezos from being rich. Peter Thiel put in $2,000 and created billions. He never did backdoor Roths or Mega Backdoors. He's got a big hedge fund or a private equity fund. He's not worried about the Mega Backdoor. So it's short-sighted policy. We know why they did it, right? They think, at least Senator Wyden believes that there's a lot of shenanigans going on in the Roth IRAs, and they're just trying to limit Roth IRAs, limit ability wealthy people, at least anyone that makes over $208,000, they believe is wealthy, I guess, to do Roth IRAs or Mega Backdoors. And again, the Mega Backdoor, there's no income threshold, right? So you can be a sole practitioner accountant, make $100,000 a year. You're not wealthy. You have a nice job, you're making six figures. That's great. And maybe you wanted to do the Mega Backdoor because you wanted to put away as much as you can in Roth. They're going to stop you from doing it. So now you're going to have to do employee deferral / profit sharing, put away less money, and actually probably have some pre-tax money there too, which will create tax deductions, but also reduce taxable income for the Fed. So it's kind of backwards policy. It's not even short-sighted. It really makes no sense. I don't know the policy. They are going to get a cap, so they're going to stop the Mega Backdoor, the Mega Roth, right? Or Mega Retirement Accounts. Even though the cap will kick in 2029 for the 2028 taxable year, there won't be taxpayers with over $10 million adjusted for inflation in the next 7 or 8 years. So that will solve the runaway Roth. So what's happening here is you're stopping backdoor Roths and Mega Backdoors, which is just going to, first of all, cause people to lose faith in the retirement system and cause more savers to save in other areas, whether it's pre-tax or maybe not even save, right? Maybe there are some folks like me that are big Roth people, and if I can't save in Roth, maybe I'm just not going to save, right? I'll just save it personally or spend it or just buy real estate or do other things and not keep it in a retirement account. So it's I think a very unwise move. It's definitely not popular. No, I don't think anyone other than Senator Wyden and his team support this. I talked to members of Congress about this, and they're just not understanding it. And they're like, well, it's not raising any revenue. I'm not sure why it's in there. Let me look at it. But no one's really pushing hard to get it out because it's not impacting an industry specifically. It's just hurting all of us, right? It's hurting everyday regular old Americans that are low to middle class that want to save more and move up in the in the income ladder and have more money at retirement for their families, and that's going to hurt us. So anyways, this is basically the last 7 or so weeks to do it. So hopefully you're listening to this. It's 2021. If you're self-employed, you still can set up a solo K and do the Mega Backdoor 58 or 64.5. You just need to have that much in income. If you're not self-employed and you want to put a little bit more into a Roth IRA, irrespective of income levels, the Backdoor Roth IRA is your ticket, but it probably will go away in 2022. So this is your last chance. And hopefully, again, you're listening to this and you still have some time to make a move. I know I'm going to do my last Backdoor Roth this year. I'm not self-employed, right? So I can't do the Mega Backdoor, but I have a number of clients that are super upset. After I did a YouTube live last week, updating everyone on the most recent version of the tax bill, I got a lot of emails and some calls just stating their unhappiness and not understanding the intent behind these two provisions, which would eliminate, again, the backdoor and the mega. And I agree. I don't see the public policy. It's not like a cap where you can see it. Hey, there's a public policy. We don't want people having hundreds of $1 million in a tax-free Roth account. Okay, I don't agree, but I can see the argument. This I don't see because it's not helping rich people. Rich people are not doing backdoor Roths. They don't care about $6,000. And super rich people are not self-employed. They don't have the ability to do the Mega Backdoor. So who is this hurting? It's hurting small business owners. It's hurting middle class, low middle class people like us that just want to put away a little bit more into a Roth IRA that maybe make over 208. They're married, filed jointly. Again, 208 is a lot of money, but it's not rich, right? I know a lot of people that make over $208,000 as a family and are struggling just to get by, pay credit card bills, pay mortgage. With inflation and the cost of living, cost of real estate, $208,000 for a family is money. Don't get me wrong, but you're not living large like you thought you would, 7-8 years ago. You're still kind of middle class. You're still trying to get by. So for them to stop people from saving a little bit more at that low threshold, if they wanted to put an income level at $1 million or $2 million, fine. But that's not happening. The Roth income levels are so low that it's hurting middle class small business owners from adding more money, which in turn will hurt our families and our kids. And it's just too bad. So there you go. There's still some time, 7 or so weeks to do it. I'll do a bunch more podcasts just in case you missed this one or just get busy and put this idea aside. I'll do one towards the end of December if the tax bill passes, letting people know that you got a few days left to do the backdoor Roth or set up a solo K and do the Mega Backdoor solo K. So thanks for listening. Really appreciate it. Hope you guys have a great week and talk to everyone again next Tuesday. Take care.